Happy Easter, right? Happy Easter indeed. Welcome to the program. We have all sorts of things to talk about on this week's program, as we do each and every week. Well, shoot, as we've been doing each and every week for over 30 years now on the program. So welcome to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. This week's program, we're going to deal with, I guess, the deadline of sorts, right? April 15th coming up, but it's not really April 15th. The folks in Washington kicked the can down the road for 30 days to May 15th for your tax filing deadline. So, but there's certainly some things to talk about as it relates to taxes, particularly with the latest proposals out of Washington, and along with the commentary that we'll provide on Bitcoin as well, because there's some interesting developments as it relates to cryptocurrency and your tax return. For the first time ever, folks in Washington want to know what your cryptocurrency activity is all about. So we'll talk about that and then relate that to some of the tax proposals that are floating around in Washington. One this past week had to deal with elimination of the step up in basis on capital gain. That's a big one. That saves taxpayers over $41 billion per year. So you may want to listen to that part of the program. Plus, we'll talk about how to determine your ideal retirement withdrawal rate. All that on this week's program. My name is Joel Garris. I'm a certified financial planner, certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciary stands ready this week to help you change your life with a successful and cost-effective financial plan that produces superior investment results and provides you with peace of mind for the future. So the story begins in the year 2009, and the reality is that that was sort of when Bitcoin was designed. It was designed as a way to sort of do a peer-to-peer system of payments without having a centralized oversight. And so the thought was that when you're using blockchain technology, which was sort of like an independent, open public ledger, that was the genesis of where Bitcoin came from. And so, over the next few years, 2009, you didn't really hear anything about, Bitcoin for the next few years. And then starting about 2017, the narrative sort of emerged that it should be thought of more as an investment rather than a payment system. So it started out really as kind of a peer-to-peer payment system whereby the blockchain technology is able to verify and keep track of where that transaction is, or where the transaction is in sort of the sequence of transactions. But then of late, 3-4 years ago, the narrative sort of changed as, this is something that needs to be thought of more of as an investment than a payment system. And so that sort of starts to get and underscore some of the limitations that we see as it relates to Bitcoin. The folks at the Commodities and Futures Trading Commission classify it as a commodity. So much like cattle futures or pig futures or any orange juice futures, then you've got Bitcoin as well. One of the things that makes Bitcoin relatively unique in terms of the different assets out there is that it can be traded 24 hours a day, 7 days a week. At last count, there were over 4,500 cryptocurrencies worldwide. 4,500 cryptocurrencies worldwide. And of course, one of the things that you know about Bitcoin, because it sort of hides the identity of who is on the other side of the transaction. Transactions can't be reversed. There's no headquarters, there's no 800 numbers, there's nobody to call and complain when something doesn't quite go the way that you wanted it to. So fast forward to then 2017, we had this change of story, if you will, as it relates to Bitcoin from being a peer-to-peer system of payments to 2017 more of this notion of think of it as an investment rather than a payment system. And that coincides with sort of the rise of populism and anti-government sentiment. that give credence to, oh, well, this cryptocurrency is going to replace the US dollar and things like that. And then you layer onto that the excess cash that is out there. And you start to begin to see the host of limitations that then comes with Bitcoin. So we're going to talk about some of those today, and really as an explanation of sort of our view on what it is and what it, more importantly, what it isn't from an investment perspective. So one of the biggest limitations is for Bitcoin is the inability to evolve. It is hard coded, if you will, to exactly 21 million Bitcoins. The price entirely dependent then, because it is hardwired, 21 million available coins out there. The price then is entirely dependent on what other people will pay for it. Okay, so therein comes into play the sort of the greater fool theory, right? It's fine, the price is justifiable as long as there is somebody on the other side of the transaction who stands ready to provide the other half of the transaction, right? Because every transaction, whether it's a stock, a Bitcoin, or a piece of real estate, there's a buyer and a seller. Well, what happens if you run out of buyers? And that's sort of the greater fool theory, is that eventually you run out of fools when it comes to those kinds of things, where the price, when the price is solely dependent upon what other people will pay for it, you may very well get to the point where there isn't other people willing to pay the price that something has gone up to. And then consequently, what typically happens there is that the price then precipitously declines very, very quickly. That's the notion of how a bubble works. That's the notion of how any of that stuff always works when you see those big run-ups. So beware of the limitation that it is in fact hard-coded, that it is solely, entirely dependent upon what somebody else is going to pay for it. Because the reality is it doesn't create any value in and of itself. All it can do is fluctuate in price based upon what others are saying. And so if you think about that, and so you take a minute and you contrast, say, Bitcoin or cryptocurrency with say gold or even a company, right? So gold is a physical asset, right? You touch it and it has physical properties that are sought after, right? It conducts electricity, its resistance to corrosion, and that creates some level of commercial demand, right? 70% of the demand for gold, in fact, comes from industrial electronics, consumer jewelry, and central banks. So there's definitely that demand that exists out there, for gold, that just there isn't a commercial demand for cryptocurrency. Similarly with a company creates a product, right? They sell it, they create cash flow, create profit. Bitcoin has neither of that. No commercial demand, no ability to create a cash flow. So there's some other limitations as well. We're going to take a break because the music's telling us we have to take a break. And when we come back, we will continue on with this conversation a bit about Bitcoin, and then we'll kind of shift into some of the new rules that the IRS is putting into place and a discussion of cap gains and how that works. Coming up next year on Dollars and Cents. On the program, we are talking a little bit about Bitcoin, some of the limitations that we see that make it very different from what you would traditionally look at as an investment. Really more, in our view, as pure speculation in terms of what's driving the price, because the price of cryptocurrency in general and beyond just kind of Bitcoin's obviously the one that everybody knows about, but there's like 4,500 different cryptocurrencies today. There's like no barriers to you creating your own cryptocurrency. As long as you can kind of figure out the blockchain technology, hey, you can create your own version of cryptocurrency, and a lot of people have, hence the 4,500 different cryptocurrencies that are out there today. And in the last segment, we were sort of talking about the inability of these types of vehicles to ultimately evolve, because their value is totally dependent upon what other people will pay for it. They're not going to create any value of themselves. The value is totally driven by what someone else is willing to pay for that. If you contrast that with, say, gold or a company or a piece of real estate, gold, that's a physical element, right? And that has some properties that create commercial demand. It's resistant to corrosion, it conducts electricity, and the reality is that if you look at gold demand, 70% of gold demand is typically made up of industrial electronics, consumer jewelry, and central banks. So that automatically sort of puts a baseline in there, if you will. And obviously, if the demand for gold as a physical commodity increases, then obviously that helps to provide some level of support to the underlying price of gold. So if you think about a company builds a product, makes a product, sells it at a profit, that profit then becomes a cash flow. So companies have the ability to create value through creating cash flows by creating a product. Bitcoin, on the other hand, has neither of that. There's no commercial demand and there's no ability to create a cash flow. The value is solely based upon what somebody else is going to pay for it, which gets us to the greater fool theory, which works out great for the price to keep going up as long as there is somebody else on the other side of the transaction. But when the fools disappear, then the price winds up declining very rapidly. So again, cryptocurrency, not really, in our view, any kind of an investment because of those significant limitations. And the reality is, look, forget about it being environmentally friendly, right? If we're entering this new era where we're going to be much more conscious, and rightfully so, in terms of our environment and power consumption and things like that, the problem with cryptocurrency is the very decentralized nature of it, right? It doesn't have a centralized location. So that means there's thousands of high-speed computers all over the world chasing it. It's estimated that the cryptocurrency network consumes as much power as the entire country of Argentina. So that's a big consumption of power that isn't really all that environmentally friendly. And then, of course, here's the reality. If you've looked at your 2020 tax return, like sharks in the water, the regulators are circling on this. Operation Hidden Treasure, courtesy of the IRS, is a joint effort between the Civil Office of Fraud Enforcement and the Criminal Investigation Unit at the IRS, training their agents to look at blockchains to root out tax evasion among crypto users, specifically looking at those that structure transactions just below the reportable requirements of the 10,000 limit, or using shell companies to hide their funds, or hopping on and off the chain. The IRS is watching, and we've talked about this before. There's now a question on the tax return that asks, did you sell, acquire, exchange, or otherwise use any type of cryptocurrency of any kind? And it's a very obvious question on the return, and it's a very broad question, and intentionally so, because the IRS wants to know that, because the level of regulation that is now happening is much more dramatic than it has ever been. Because here's the thing, and this part of it of the program here is going to really sort of recap for all of our listeners the tax implications on any property, on any asset, because after all, cryptocurrency is classified as property, much like real estate, much like a stock. Any of that is property. So when you're talking about property, the capital gains and the capital gains rates comes into play. So we want to take this part of the program, sort of recap what the rules are as it relates to capital gains or losses, and how you report that on your taxes, and what the tax implications are on that. So welcome back to Dollars and Cents, of course. We're Central Florida's longest running radio program, coming to you on the News Radio WFLA Orlando network, along with 96.9 The Game. We're one of the top 25 financial planning podcasts on the World Wide Web as well. So make sure you subscribe to us on your favorite podcast channel, or simply subscribe to us on YouTube at our Nelson Financial Planning channel as well. My name is Joel Garris. I'm a certified financial planner, certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciary stands ready this week to help you change your life with a successful and cost-effective financial plan. So, and when it comes to property, whether it's real estate or a stock or cryptocurrency, capital gains then comes into play. So let's start off first by sort of recapping how capital gains work. So the first thing you got to know is, well, did I have a gain or did I have a loss? So you look very simply at how much money I put into something and then compare that to, okay, what did I get when I sold it? If it was more, obviously that's a gain. If it was less, that is a loss. The next thing you need to look at, though, is if it is a gain, what's the time period between those two dates of when I bought it versus when I sold it? If it's a loss, it doesn't matter. Whether it's 1 day or 10 years, a loss is a loss. You can always report that on your tax return against capital gains, and to the extent that your losses exceed your gains, then you wind up being able to use up to $3,000 or $3,000 of a loss against other income. If that means you still have additional losses, then they will in fact carry forward to future years. So that's how losses work. It doesn't really matter kind of the time frame. I mean, the only reason why it matters is it depends on which part of Schedule D that you're reporting, but effectively a loss is a loss, whether it's long-term or short-term. It's a loss on the return. In terms of the capital gain, though, that's where things get a little different, right? You've got to know the difference between short-term versus long-term. And so if the date of when you bought it versus when you sold it is less than 12 months, that becomes short-term. More than 12 months, and that becomes long-term. And that's where the different tax rates come into play, because if it's short-term, then it is taxed at ordinary income tax rate. So much like your wage income, then you've got to pay whatever your marginal tax rate is on the amount of that short-term capital gain. That particularly comes into play if you're trading stocks or cryptocurrencies or whatever the case may be. Great, you may have gains, but those are going to be taxed just like your work income would be. On the flip side, if it's a long-term capital gain, good news there is that if you're in the 10 or 12% income tax rate, then the rate on those long-term capital gains is in fact zero. That's right, zero. So you don't pay any tax on long-term capital gains if you are in those lower income tax brackets. That's a pretty powerful option for folks that are in those brackets. If they have a capital gain, that they don't have to actually pay any taxes on it. If you are in any of the tax rates above the 12%, and that kind of kicks in at about $100,000 of total income as a married couple, because once you do the standard deduction and things like that, you get to your taxable income. Reality is, yeah, gross income about $100,000. Once you're above that, then your long-term capital gain rate is 15%, which again, still better than the 22, 24 and on up income tax rates that you would incur. So understand, kind of the difference on how the capital gains works and how you report it. No matter the amount, right? You've got to report it. So whether it's $10 or a million, your capital gain or your disposition of property has to be sold. And here's where kind of the cryptocurrency thing gets a little even funkier, if you will, because you sell 100 shares of Microsoft, right? You're going to get a check. And so that's readily apparent. Okay, yeah, I sold it and I got cash and I deposited it in my checking account and then I, used that to buy something. The unique factor of cryptocurrency is the ability to exchange it. But an exchange, in fact, is still spending it in the eyes of the IRS. So it doesn't change anything than if you were just simply selling it and taking the cash and then turning around and using the cash to buy something. So understand that like, for example, if you wanted to use your Bitcoin and go buy a Tesla, and you bought your Bitcoin, it was $3,000, and now it's worth, like $50,000, and you walk into the Tesla showroom and say, okay, I'm going to buy a Tesla, and here's some Bitcoin. Well, that's all fine and dandy. You'll drive off the lot with a Tesla, but you will also have a sale of your cryptocurrency to report on your tax return. When you exchange it, spending cryptocurrency is the same thing as a sale in the eyes of the IRS. So be careful of how all of this stuff works. We'll take a break and continue on here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning. So let's just underscore that last comment in the prior segment. So if you've got cryptocurrency, what's unique about it is that if you're using it to purchase something, in the eyes of the IRS, that is in fact a sales transaction that must be reported on your tax return. So here's the simple example, right? You bought Bitcoin or whatever it was, and it was $3,000. You walk into the Tesla showroom and you say, hey, I'm going to buy a Tesla with my Bitcoin because my Bitcoin's now worth $50,000. Although you probably need a couple of Bitcoins to buy a Tesla if you want to get the nice one. But anyway, so you give Tesla the Bitcoin, you hand it over to them, or you don't hand it over to them because it's all electronic, but you transfer it to them. You spend your Bitcoin, you drive off the lot with your fancy little Tesla, and yeah, guess what? The IRS says, okay, that was just a sale of Bitcoin, and the reality is that that is a transaction that needs to be reported on your tax return. Here's hoping you had that for longer than a year. Otherwise, the entire gain on that is going to be short-term capital gain. You're going to have to pay ordinary income tax rates on it and don't even get the benefit of capital gains rates, because you need to hold it for at least 12 months in order to get that benefit. So just understand how that works. And the reality is once you exchange it or really spend it, then that is in fact a sale transaction and generates a tax consequence on your tax return. So in that example, if you bought the Bitcoin for $3,000 and it's worth $50,000, and you hand it over to or transfer it over to the folks at Tesla, well, that's a basis of $3,000, value is when you sold it is $50,000, so that's a $47,000 capital gain that you would need to report on your taxes. So beware of that, because obviously the April 15th tax deadline is changing, and specifically those types of transactions are going to appear much more frequently for the first time on 2020, because the IRS really is focusing on that and asking everybody the question of, did they do anything with cryptocurrency? So obviously April 15th, fast approaching. May 15th is the new deadline though, and applies to returns and funding HSAs, IRAs, and things like that. We're going to talk about some of the tax changes that are coming up here in this segment, particularly one of the proposals that started to float around and get a little bit more traction than what we've seen in the past, just this past week in Washington. And this one really is a big one. So welcome to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're Central Florida's longest running radio program, coming to you on the News Radio WFLA Orlando network, along with 96.9 The Game. We also happen to be one of the top 25 financial planning podcasts on the World Wide Web, with over 15,000 downloads of our program. Make sure you subscribe to our podcast channel on your favorite podcast channel a platform of choice, whether that's Spotify, iTunes, or what have you. You can also certainly subscribe to our YouTube channel as well at Nelson Financial Planning. Have trouble finding us on any of those platforms? Just go to our website, nelsonfinancialplanning.com. Upper right-hand corner, you'll see a bunch of links or a bunch of little icons. Click on the one that looks most familiar to you, and you will get directly connected to our particular channels on any of those social media platforms. So, my name, of course, Joel Garris. I'm a certified financial planner, certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this week to help you change your life with a successful and cost-effective financial plan. So one of the things on our website, speaking of our website, is a blog post that we actually did sort of on this topic about some new tax changes that could change your retirement. We're going to kind of spend some time focusing on that, because we want to really highlight one of those potential tax changes that we were talking about in a blog post. We did this blog post probably a couple of weeks ago now, And in it, we talk about sort of the potential for higher Social Security taxes and some other tax changes, but one in particular really got a lot of traction this past week in Washington. So let's talk about some of the things that we mentioned on the blog. And for more information, obviously, we would encourage you to check that out on our website at nelsonfinancialplanning.com. First and foremost is the potential for higher Social Security taxes. Right now, you pay 12.4%, or if you work for an employer, you pay half of that and the employer pays the other half. If you work for yourself, then you pay both sides of it. But basically, it's 12.4% to Social Security up to the first $142,800 of wages that you make in the year 2021. Now that limit of the amount of compensation every year goes up. Last year, 2020, that number was $137,700, and so every year it kind of trickles up a little bit so that more of your wages is you are required to pay Social Security tax on. One of the big proposals in Washington then is to have that Social Security tax come back into play at higher income levels. So in essence, you pay the 12.4, or you and your employer pay in combination the 12.4 up to $142,800 for the year 2021, and then maybe out at like $400,000 of income or something like that, it then kicks in a new requirement to pay the Social Security tax at 12.4% for that income at those levels and above in terms of trying to shore up the Social Security system. And then also, similarly, changes to deductions. The higher standard deduction that was instituted a few years back certainly seems to us to be here to stay, because it does simplify filing of returns in that you don't have to kind of go through the process of itemizing your deductions. To the extent that you do still itemize, and that's roughly about 7% of the filers now versus about a third that used to itemize prior to the higher standard deduction. What's probably coming back is sort of a cap on those itemized deductions based upon your total income. So it might be capped at 25 or 30%, meaning you can't just write off a bunch of things and bring your income down to zero with your deductions, because those deductions are going to be limited. But the higher standard deduction, which today, married couple, $24,800, you also get kickers on or extra amounts if you're over 65. Some pretty high thresholds in terms of that higher deduction. But one of the biggest things, and we talk a little bit about this in the blog post, and it's certainly gotten a lot of traction in Washington this past week, is the elimination of the step up in basis on property. So whether that's real estate, whether that's a stock, whatever that case may be, when you start talking about the elimination and the step up in basis that occurs when somebody passes, this is in fact a pretty significant tax issue. It's estimated that this step up in basis that occurs when people pass saves taxpayers to the tune of $41 billion per year. So this is not a small thing. So we're going to slide to a break. When we come back, we're going to set the table of what exactly this step up is and how it all works, and who's going to be impacted and who might be okay on it based upon the conversations that are happening in Washington. So stay tuned with us through the break here on Dollars and Cents with your host, Joel Garris of Nelson Financial Planning. Welcome back to the program, ladies and gentlemen. We are talking predominantly today on this Easter Sunday morning about taxes, and I guess that's appropriate, right? Because the traditional tax filing deadline is not that far away. We've got an extra 30 days this year because of all of the changes that happen in the tax law. We've certainly spent a lot of time on prior programs kind of detailing those and some of the big changes for 2020. We want to continue to sort of highlight two in particular for our listeners because they're pretty important and they relate to your 2020 tax return, which at the time that these rule changes passed, tens of millions of Americans had already filed their tax return. So you may be wondering, okay, well, what do I need to do? Because if the rules changed and I can save money, how do I get that money? Well, unfortunately, the IRS doesn't really explain that in great detail at this point. What they have said is they don't want you to run out and amend your tax return. So what are the two big things that changed? We want to certainly highlight that on the program here on Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. My name is Joel Garris, certified financial planner, certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciary stands ready this week to help you change your life with a successful and cost-effective financial plan. So the two big changes for 2020, and this is pretty important. So if you know anybody that got unemployment insurance, got unemployment compensation last year, or had insurance through the healthcare exchange, otherwise known as Obamacare, these are the two important points. So number one, unemployment compensation is tax-free up to $10,200 per person, and assuming your income is less than $150,000. We talked a little bit about this on the prior programs, but that $150,000 limit applies regardless of the type of tax return that you're filing. So if you're a married filing joint couple and your income is above 150, so you might not be eligible for the tax-free treatment of the unemployment compensation, this year you may want to look, in fact, at filing separately, which is something that often people don't look at because there's really no difference. But this year, there is, particularly with this unemployment stuff. So be aware of that. If you collected unemployment, you've got to really put some thought into your tax return and what's the best strategy for it. Number two, the premium tax credit as it relates to Obamacare, insurance through the healthcare exchange. If for some reason your tax return is showing that you owe back some of that premium tax credit, the good news is that that has been waived for 2020, so you don't have to pay that back. So those are two very significant developments as it relates to your 2020 return, and those are real. Those have happened. Those are the law of the land. This proposal that we're talking about today that has to deal with elimination of the step up in basis is in fact a proposal, but it's certainly something to get thinking about because it has some pretty significant implications on investments and retirement and strategies in terms of estate planning and investment planning strategies. So here's how it works, right? So if you've got an asset, so whether that's stock or a second home or even your Bitcoin, the reality is that it appreciates, right? So again, we're not talking about something inside of a retirement account. That's totally different. All those dollars are going to be fully taxed as you take them out, unless it's a Roth. But again, don't think retirement accounts on this part of the conversation. Think about assets that you have that are outside of that. And hopefully those assets are all appreciating. And then what happens is if you were to sell those, right, we've talked about this earlier in the program, if you sell those, then you have to recognize whether it's a capital gain or not, and then report that on your tax return. But when you die, that changes. So what changes there is something called a step up in basis to the value at the date of death. Now, in English, what that means is that if you bought a stock at $10 a share and it went up to $30 a share, and you sold it the day prior you died, you'd have a $20 per share capital gain that you'd have to pay on your taxes. If you didn't sell it and you died, then your beneficiaries would have their original price, if you will, of acquisition be increased up to the value at the date of death, which is the $30. And so if they decided to immediately then sell that stock, there would be no tax implications whatsoever. Now, this is not something new. It's been around for decades and decades and decades in the tax code, this notion of at death, we're not going to tax unrealized appreciation, meaning appreciation that was in assets and you just didn't sell them during the course of your life. We're not going to go back and then tax them like you should have sold them all the day prior to which you died. This has been around for forever, and as we've been mentioning, is one of a big tax savings on the tax return. It saves taxpayers to the tune of $41 billion per year. Now here's the proposal. and this one may very well have some legs. They want to pass. They want to make sure that if there's a embedded capital gain, if you will, that's more than a million, then they are in fact going to eliminate that option to step up in basis. So let's say you had a stock and there was a $100,000 gain in that. You're going to be okay on that as a recipient or beneficiary of that stock if that person passes. But if the gain then starts to shift to be in total, and this is going to be the total amount, it's not just going to be on one asset or one stock or whatever the case may be. They're talking about the total picture. So if you inherit stocks with 200,000 of gain and a house with a $400,000 gain, the reality is that they're going to look at all of that, and if those total gains are less than $1 million, then you're going to be okay and not have to worry about paying capital gains on it, and you're going to get the benefit of that step up in basis. If that is over $1 million, then the amount that's over $1 million, you do not enjoy that step up, and you in fact will have to pay the full capital gain on that appreciation. So it's going to be very important to kind of look at the nature of one's assets and exactly what's the best way to sort of address this particular issue, because this plan we think probably has some legs to it. As we were saying in the blog post that we put up a couple of weeks ago, the details of the proposal that came out just this past week have a much greater legs, if you will, to them versus some of the other times where we've seen this elimination of step up in basis. One of the last times that it was suggested back in 2015, they put the cap at $100,000, which obviously is a pretty low number to go with. Kind of $1 million cap, and then them giving you 7 years, 8 years to kind of pay it back. Then that seems to us to be something that might have some more likelihood of getting passed. So obviously on the program we will keep you informed as that stuff develops, but we wanted to get that out there on the table to you so that you kind of understand, okay, if my parents or my aunts, uncles, cousins, or whoever I might be the beneficiary on have these highly appreciated assets, then that's going to really kind of change what that tax picture looks like. And so you've really got to start kind of thinking through that and planning through that. And then if you are somebody who has those types of assets, you've got some opportunities that you need to be thinking about as well. So anyway, we'll wrap it on up and get on out of here. Thanks for listening to the program. Have a great Easter Sunday here on Dollars and Cents with Joel Garrett.